Hi, everyone. I'm Mike Pacito with Littman Gregory, and thanks for joining us today. We have a great call in store for you today. First, we're going to be doing a quick 10-minute update on our Alternative Strategies Fund for clients and prospective clients with co-portfolio manager Jason Steuerwalt. And then we're going to shift over to an interview discussion between Littman Gregory CIO Jeremy DeGroot and FPA managing partner and portfolio manager Steven Romick, going across the markets. So that should make for a really interesting conversation. We've received some questions already through registration, so thanks to everyone who sent those questions in. We'll try to address those during the call, but if you also have questions that you'd like us to address during the call, just submit them through the interface on the bottom of the Zoom screen, and we'll try to address them probably in the back end of the discussion. So starting off with our All-Weather Alternative Strategies Fund, where Steve Romick is actually one of the 5 portfolio managers on the fund. Some quick takeaways in terms of performance, and then I'll hand it over to Jason to go over a quick update in terms of the managers and the underlying strategies. So Q1 was solid. You'll see that the 3-month return was 2.44%. 12-month return was 20.14%. That beat all of our major benchmarks. And for clients who use the fund to diversify their fixed income allocations, the fund beat the AG substantially. For the quarter, it beat the AG by almost 500 basis points. And with a trailing 12-month yield of almost 3%, the fund has a yield on the portfolio of almost twice the AG itself. In terms of the compounded line chart on the next slide, you'll see that we did see some increased volatility at the onset of the COVID crisis. Beta on the fund went up for a short time, but still was substantially less than equities. And the fund quickly returned to its more typical behavior when those dislocations relocated, so to speak. Next slide, you'll see it is a bar chart, and the fund is in orange. It gives a year-by-year look of the fund against the AG, the HFRX, and the Morningstar Multi-Alt category. Fund continues to have the highest Sharpe ratio in the category, and it's coming up on its 10-year anniversary at the end of September. Over the lifespan of the fund, it's had consistent, reliable, low volatility returns and delivered nice alpha for clients. So we're really happy with the fund. We hope that our clients are as well. And we hope that prospective clients will continue to give the fund a good look. And with that, Jason, I'm going to hand it over to you. There's one more slide that has a little bit of performance data on it if you'd like to touch on anything there. Otherwise, a short update on the manager sleeves and their positioning.
Yeah, nothing too much to say on this sleeve. There are a lot of numbers here, obviously. I think the nice one, which you alluded to earlier, was the Sharpe ratio, still very strong at 0.9. Compared to the other alternatives on the page, except for the Russell 1000, which is kind of a mind-blowingly large number for a 10-year period. But jumping to the managers, so I guess to start, we got nice contributions in Q1. Fund was up 2.4%. We got nice contributions from the value / reopening themes, I'd say. But still feel like we have good return potential in the fund, remaining, and it's not overly exposed to those themes. It's got a balance and some dry powder. But DCI, starting on a manager that did not benefit from that theme, was down slightly net of fees in Q1, down by less than 10 basis points. Going back to last year, DCI held up really well during the pandemic and started making some nice gains during the middle of the year, and then got hurt post-vaccine announcements at the end of the year as things that had been beaten down rallied, the value trade started, and that really continued into Q1 as they were really hurt by the magnitude of the value reopening rally. They definitely have positions that benefit from that on the long side, but not as much to be able to keep up with the short side of their long short sleeve. I won't go through all the exposures here. You can read those, but I would note that in the bond portfolio, the yield is about 3% net of the credit hedges. So some nice tailwind there. And we started seeing some performance traction towards the end of March, with fundamentals driving performance rather than kind of the risk off, risk on behavior that we've seen a lot of. So that's a positive, kind of somewhat offset by a lower spread environment, which isn't great for them overall. So kind of a mixed environment, but trending in the right direction in terms of fundamentals moving prices. If we go to DoubleLine, they were up about 1.7% in Q1, not surprisingly outperforming the AG by quite a bit. given the composition of the portfolio and a much lower duration. ABS was a strong contributor where aviation-backed securities performed very strongly, again, reopening economic growth theme, as well as CMBS, particularly in the hospitality sector. Agency MBS was the only sector that was a detractor from performance, which isn't surprising given its longer duration and the rise in treasury yields during the quarter. One thing to note here is that non-agency RMBS is now down to about a third of the portfolio. That's historically been the biggest part of double line sleeve. The other credit sectors, CMBS, CLOs, ABS, et cetera, are now over 40% of the portfolio. So that's something to note. And given that the structured credit areas were the slowest to recover coming out of the pandemic, they still have quite a bit of value left in those, as you can see by the yield of almost 6% at the end of the quarter and a duration of only 3.3. Going to FPA, I won't spend too much time here since Steven is on the call with us, obviously, but their sleeve was up about 8.8% in Q1, benefiting from the value recovery. Although I'll note, and I'm sure Steven will as well, it's not purely a value portfolio by any means. They have a number of strong, high quality, compounding dominant businesses, as well as some of the value sectors like financials and industrials. Financials were the biggest contributor in Q1. They did trim some of those. Not a big change in terms of sector exposure, with still about 75-76% net long equity, a little bit of credit, and a good bit of dry powder, about 20% cash. If we go to Loomis, they were up about 80 basis points in Q1. Structured credit and high yield were the biggest positive contributors here, while emerging markets was challenged by the US dollar strength. They still have a decent amount of net long risk exposure. The high yield is about 35% and structured credit about 30%, although it's significantly lower than it was a year ago. Loomis took the opportunity. They were probably the most aggressive in terms of rotating their portfolio during the pandemic, going from about 0% in high yield exposure up to around 50%, which was a mix of cash bonds as well as CDX. So they've obviously pared that back quite a bit, but still have some exposure there given the supportive environment and low defaults regime that we're in. Still a nice yield on this portfolio of about 4% and a relatively low duration of 3. And finally, Water Island. So they were up 3.2% in the quarter, continuing a nice trend of performance from them, held up relatively well during the pandemic and then benefited really strongly the rest of the year. So their contributions in Q1 were from both the hard and soft catalyst, tilted about 70-30 toward the hard catalyst side. In terms of their net exposure, the vast majority of it is in the hard catalyst merger positions. They're still very positive on the environment, given a sharp pickup in the deal volume from the obvious big slowdown in Q1, Q2 of last year, and a lot of private equity dry powder on the sidelines waiting to be invested. So good spread environment, good deal environment. And just quickly to note on the SPACs, which were a strong contributor for them last year, even though they were less than 10% of Water Island's portfolio. Water Island last year became increasingly invested in SPACs over the second half of the year. Again, they were not a huge part of the book, but were really strong contributors to returns. They had a basket of SPACs on. They were very selective in terms of the sponsor teams that they invested with, and very sensitive to the valuations, and were quick to cut when they felt things were getting too far ahead. They also did a handful of PIPE transactions, generated really nice returns there. And SPACs were profitable in Q1, but during February, their timing was actually really good here. They cut back exposure quite significantly during Q1 as the market was just getting ridiculously overheated. So I guess that's what I'd note there in terms of significant updates. And with that, I'll hand it over to Jeremy.
Okay, thank you. I'm going to welcome Steven Romick on. It's pretty interesting, actually, Steven. It was really exactly 1 year ago that you joined us on our Alternative Strategies webinar. I mean, literally the first week of May. As obviously a lot has transpired since then, but it's good to see you. Welcome back. I did shave in your honor, as you noted in our pregame conference. So it's good to see you. Thanks for your time today.
For those of you who weren't on that call, which is most of you, it was looked like a very tough year for Jeremy DeGroot, but he's cleaned himself up.
I did. I'm back. So let's see. So just to set the stage, first, let me mention that listeners, we welcome your questions in the Q&A box on Zoom. We're probably all familiar with the routine here, but you can type in questions and I will be able to monitor those and work them into our discussion where appropriate. We'll shoot for ending at the top of the hour. We have a lot of ground. Oh, my video is okay. Sorry. It's great always talking with Steven because he's a global investor. He and his team look across capital structures, across market caps, equities, fixed income, and so forth. So basically the world is their investment oyster. But to set the stage, we'll start off with a bigger picture, kind of your bigger picture take, setting the stage of the financial markets, and to the extent it's relevant, the macroeconomic backdrop. And then we'll dig into, where the rubber meets the road in terms of what you've been doing in the portfolio, the areas of investment opportunity, throughout this really incredible market rebound over the past 13 months, and where you have concerns and risks. And so you did prepare some slides, which I think, are useful for the backdrop. The first couple touch on valuations for the US equity markets. And I'll just say,
We lost you, Jeremy.
challenging and challenged, I think, absolute value investors, for at least the five. Can you hear me?
Yeah, you're back.
Okay, sorry. So basically, I'll just let you jump in. I mean, you provided a couple of slides here on on valuations, different ways of looking at that for the market. So, what would you highlight in these next two slides? This one and the.
Yeah, so I think there's a lot to unpack here on this one relatively simple slide that shows both the S&P 500 growth index versus the S&P 500 value index. And I think that the gap between the two is, almost as wide as it's ever been, not quite as wide as it was back in the peak of the internet bubble. However, I think that it belies, some alternative considerations. I think you have to be taken into account, which is that if you actually look at the value index, I don't know exactly what the numbers are, but the growth in earnings for the value index has been terrible in this time frame. So there's no wonder that the growth index has done so much better. Now, I think that for us, the difference between growth and value is a fuzzy line, because everything we buy are growing businesses. Some are growing better than others. And I think the greatest difference for what we do as compared to just like looking at the growth stock indices on their own is that to us, price matters. But when you think about being a value investor, for us, it's merely about investing with a margin of safety, buying an asset that is at a sizable enough discount to its fair market value that you're comfortable being able to own that asset and know that you're relatively protected, assuming you've underwritten that asset correctly. We want to own those businesses, and so what's happened, like in the past, in the Graham and Doddyan kind of value investing construct, which was really about in the protection of the balance sheet. Today, the protection falls more, I would argue, for the business, because so many of the companies that comprise this blue line were the disruptors, and so many of this, I'm a little bit colorblind, I think it's a yellowish green line, that's the value index, are the disruptees. So owning a business that is the Amazon of yesteryear, Sears, buying that 20 years ago because you had all this protection of its real estate didn't end up working out so well for you. And in fact, you had that protection. I think it did give you a margin of safety at a point, but it lulled you into a false sense of security because they started selling that real estate and mortgaging that real estate and using the cash to sustain the operations as they were without making the necessary investment to compete in an online digital world in a fashion that Target did and Walmart did to more successfully compete against the likes of Amazon. So one has to be very, very thoughtful about what the future holds for any business that one owns. And the point I want to leave with is there's a lot of crappy companies in that yellow line. And we own companies in that yellow line. We own some companies in that blue line, but two things matter for us. I've said already, price matters, but the quality of the enterprise matters. So if you get a good quality enterprise at a good price, those are the businesses that we seek to own.
Yeah,
and they follow in both colors.
Those are great points. One other observation from these are price to sales ratios, and so on an absolute basis, over 5 times for the growth line. But this obscures what's going on with profit margins, which would come through in a PE, which we know are also quite high, but it's related to the quality of the businesses. As we all know, the profit margins in many of the global tech / growth leaders have also been reaching all-time highs, and there's a question of sustainability, et cetera. But on the other hand, you can't muck around with sales. There's no accounting gimmicks here. So why don't we move to the next slide, please? Which
there are accounting gimmicks. There's a lot of companies that have been busted for reporting false sales. And there's also ways to mess with, to muck around with billing at the end of quarters, et cetera. So, but I don't think that, to your larger point, I don't think that's affecting this graph.
True. There's always creative. There's endlessly creative people out there trying to beat the system. So this is, I'll let you describe it in more detail, but valuation spread. So looking within the cheapest quintile and the most expensive within the S&P 500. So a different way of not defining, value growth indices. But what would you like to highlight? What is your takeaway, and what's the relevance from this chart?
We tend to get more invested, and you spoke to our cash position, in the end, well, you didn't, but
Jason.
I think Jason spoke to our cash position going into, at the end of the quarter, which has actually increased somewhat, since then, because there's been continued, asset sales within the portfolio since quarter end. So we're giving a few points more in cash since quarter end. But what you can expect here is these peakier periods where the line spikes up. What that shows you is there's a large cohort of companies that are trading, at a discount to the market average. And as the line goes down and gets to the dotted line, which is about average where we are today, it shows you that the difference between the cheapest companies and the market average are more in line. So we like to take advantage of at points in time where something is really when they're throwing the proverbial baby out with the bathwater, and companies end up trading all too inexpensively. And that's what we try and do, and make those investments in those better quality businesses at those better prices at that point in time. So it's no great surprise that our portfolio was getting much more invested in the first quarter and second quarter of last year, because you can see that spikiness, no different than us getting more invested as we did get back, in the 08, 09 period, and no difference than we did getting more invested, when we were getting at that point in time, in 00. Yeah. So that's something you should expect from us. It's always been the case, for us in our portfolios, but actually, predating, our public fund and predating, our sleeve that we manage, for Lippman Gregory, it goes all the way back to 1990, where we've always invested that way. We look for those areas of the market that offer greater opportunity, where there's some kind of natural selling, or people don't understand something, or it could be the whole market, because the whole market is sold off. I mean, not that we buy the market, but we buy those industries and those companies that we feel offer us a more attractive risk reward. So our portfolio has a lot of what people call active share, where our portfolio is not like the market. We will be invested in certain regions or not, certain industries or not. And so we're not looking to be all things to all people at all points in time.
Definitely not. And I think the other, an observation that just jumps out is how these valuation spreads spike, maybe not surprisingly during recessions. We should draw, the shaded point there in the 2020 March.
Yes.
Market dislocation is a, kind of the common industry term, but that a lot of babies get thrown out with bathwater, but that's also reflective of market volatility and opportunities. And so having the dry powder, having the cash, to put to work, but it's also ultimately that cash for your strategy is the residual. It's not a market bet. It's based on the bottom up opportunity set, and it's not surprising that it tends to coincide when everything is generally expensive. You're finding less things to buy, which really ties into the next question and the next slide. But this is getting at the point of valuations. And again, I think I'll speak from Lippman Gregory perspective. We run broad client portfolios. We're longer term valuation driven fundamental investors, from an asset class perspective. And we've wrestled with the absolute valuation point. Look at a Cape Shiller, look at PEs, look at normalized, fundamental absolute valuation metrics relative to history, even post 80s history, are pretty high. But then you move to the relative valuation world, the equity risk premium. What do stock valuations look like compared to the alternative? You have to put your money somewhere, and bonds, broadly speaking, bonds are the alternative to stocks. We all know bond yields are 0 for cash and 1 point something for core bonds. So I'm sure you've seen the charts as well. The risk premium, the additional equity yield or expected return above expected returns from bonds, is historically still above average because yields are so low. So I wanted to just dig into this question with you a bit more to understand how you've been thinking about the impact of interest rates on your absolute, I think of you guys as absolute value investors. You're not saying, well, if I could get 6% from this stock and the S&P is 3%, I'll take a 6% return. You've always had an absolute return hurdle for taking on equity risk, typically of like low double-digit expected return. Long question to say, how are you, if at all, incorporating what may be an extended period of low interest rates, sustainably low interest rates, into your valuation approach and your business valuation approach?
So what happens with interest rates, to a great degree, will be a big driver of the market. I think interest rates have been the single biggest driver of market returns over the last 20 years. And one can ask to go back 40 years before you actually went and saw rates rising for any measurable amount for some extended period of time. So when rates decline, everything is incrementally more valuable, all else equal. And if rates remain lower for longer, one can justify a higher sustained values in the market, prices in the market, but there's no guarantee that will. We don't actually have a view as to what will happen. And the world, it just makes me nervous to think that nobody, largely nobody, very few people have lived through rising rates, and we're all expecting there to be lower rates, lower for longer. And I don't think that's unlikely. That's certainly the sovereign, incentives, right? Because they got to keep rates low just for their own balance sheets. But this slide that you're looking at really shows that impact of rates. So if you just go back and look at this dividend discount model as a proxy for valuing a security, in 2007, let's just keep the constants. Let's keep the growth rate of the company as a constant, and let's keep the dividend, a constant. And so for a company that is growing the same rate today as was growing, back, in 2007, this is 2020 rather than 21, but it's a chart from last year, the slide from last year that we're sharing with you. But the discount rate is 4 points lower because rates were, it's just your risk-free rate was significantly higher, back in 2007. You could get 5 points, for, a 10-year treasury. And what's happened since then is not only have rates gone down, but the risk premium, the spread to that risk rate is gone down, is narrowed as well as people become increasingly comfortable taking on, more risk in their portfolio. So you've seen that discount rate come down. So it's not any kind of stretch to say, hey, the discount rate's gone from 10% to 6%. Well, if the discount rate drops from 10% to 6%, you can see here in this example, all else equal, that asset is worth 5 times more. So no great shock that when rates are down, asset values are higher. And so those companies that, particularly those that are cash flowing, today are worth more, but those companies are cash flowing out in the future are worth even more still, as compared to a typical value investment that's got more cash flow in the here and now versus the proverbial growth company that is investing for the future, not making any money today, but it's worth a lot. Trust me, we'll make a lot of money 10 years from now. And you make money 10 years from now and you discount that back to today, your future values are being discounted, at a lower rate, so they become worth a lot more, and your terminal value is worth a lot more. So growth companies are disproportionately benefited by low interest rates compared to value companies. So we're very, we don't know what's going to happen. We're very sensitive to the fact that rates are low. We expect them, we wouldn't be surprised to see them remain low for extended periods, but we also know they can go higher. And the question is, why do they go higher? Are they going higher because of is it for just inflationary reasons? Companies are getting pricing, or you're not getting pricing, and your unit volume is kind of sloppy, and you're more of a stagflationary period, and your rates are higher, which would lead to a different conclusion. But what's interesting about low rates today is not just that it's affecting the values in and of themselves because you discount the future stream of cash flows in the examples I just gave, but cash flows are also, but your investors, our investors, the population as a whole is hurt by, lower rates to the extent that they have anything or want anything in some kind of fixed income security. So if your alternative is something that's lower risk, and frequently that lower risk is, shows up in the high grade bond market or treasury, or, other sovereigns, sovereign debt. But today rates are so low and you don't get a yield at your, deposit at your branch, your local bank. What do? If you want a return that even that keeps your value of your dollar from eroding, because what you've been getting at the banks is less than in your deposits is less than the rate of inflation, you are pulled into something else. For most people, that means stocks, because it offers the the liquidity to them, and they're investing in a smaller size on average, because not everybody can go out there and buy an apartment building. And so as a result, that creates a demand for securities. So between just the increasing value because of low rates in themselves, you also have this driver of demand for securities, demand for shares, which is what's helped drive the lower risk premium out there because of the lack of alternatives. But what happens in the future is anybody's guess. We have a view that look, inflation could percolate, but will it be inflation with low rates or inflation with high rates? We again don't know. But I think that one of the best ways to protect capital over the next 10 years is to own really good quality growing businesses. That doesn't mean they're not going to have marks to market, the negative marks, points in time along the way. We looked, awfully stupid a year ago because our portfolio was getting killed. Now it's since rebounded, but if you buy Marriott at 80 on its way to 60, in the midst of COVID, you're not looking very good as it drops 25% after it's already down, 40% from its high. So you don't look that great. But given where Marriott is today, we don't look as dumb today as we might have looked at a year ago with Marriott trading north of 140. And that's just one example, but I think it speaks to the need to invest with a certain amount of patience and being willing to lean into to opportunities when the market's giving them with managers that you trust.
Okay, so yeah, thanks for all that analysis. It's useful, and I mean, it's this simple example says, a stock that was worth 20 times PE is now 100 times PE. Let's see. I guess
that's not a PE. That was a dividend, but that's assumed.
Well, if you
dividend, that's the payout. That's not your earnings. But
yeah, okay, fair enough. Well, let's. I guess I'll take this to the your point on quality companies. And Jason also highlighted this in the quick update, and it's comments you've made as well before. And you've just talked about written about the quality of the portfolio is in better quality businesses, higher than I think you wrote any point you can recall in your 50, 60, 70 years in the business.
Thanks for dating me. Thanks, Jeremy.
Well, okay, we'll call 30, close enough. So that relates to the, your cash position, which is something you've talked about. You've talked about publicly regarding some of your other strategies that, so again, related to a 0% cash environment, just all these points. But can you just elaborate a bit more on this point about owning, quote, better quality businesses now? And maybe you've hit it a lot, but how does that relate to cash? And maybe just a couple quick examples of what you have in mind when you're talking about quality businesses that you own now that you might not have owned, 10 years ago.
Well, I mean, business, and I'll go back. I'll frame it from 20 years. We are more willing today to make a bet on our capabilities, to understand the business models. We look into the future to own those businesses that we think are more likely to be successful than not. And there's more businesses today that are winner take all or winner take most, types of businesses that didn't exist that way in that fashion in the past.
Yeah.
There weren't the Googles and Facebooks and Amazons, of the world, living in the world, 50 years ago. And so, today there's many businesses, and you touched on this earlier, that are better businesses with higher margins, but they're also businesses that are higher margins in part because they deliver something to the customer that others aren't, capable of. I mean, it's like there's not room for lots of Grubhubs or Uber Eats, or there's only so many that you can actually bring to market that can operate in a market and sustain in a sustainable fashion with good returns on capital. I mean, today we're early on in the streaming wars. Who are the winners going to be in the streaming wars? There's many players out there today that will not be players out there in the future. Players like I'm confident that Disney Plus and Netflix are going to be winners, but I don't know who else will be in that business. And so we have to go. It's our job to try and understand who is likely to be the winner and make a bet on those winners at that points in time when these prices are trading at reasonable levels. Now, so we'll own more of those businesses. So we own a Google today. We own a Facebook today. We bought Google in 2011 and Facebook a few years back during the Cambridge Analytica scandal. And those are obviously have been incredible stocks, but they're incredible businesses. And 20 years ago, we were less willing to buy something that was on the come, and that kept us from owning a company like Amazon. And that's shame on us. We did the work to understand the business just well enough to understand that, whoa, this is a lot of danger to our retail investment. So let's go sell our retail. So we sold all our retail, and we did a very good job by not, in avoiding the downside that's affected so many, retail, brick and mortar businesses today, as well as malls, which we used to own, at a point in time, real small REITs as well at a point in time in the past. And so we did a very good job of avoiding those mistakes, but shame on us for not owning Amazon. So when you spend a little bit of time and studying your mistakes, you realize, especially after reading the Everything Store a number of years ago, you realize that we truncated our work. We just didn't go all the way where we needed to go. So we've done that work, and we since then we deliberate carefully on owning these different businesses, and we're very careful about trying to own these businesses that are growing business. I don't think you can point to a company in our portfolio that is not likely to grow. We can argue about the level of growth, but they shouldn't be shrinking. If they're shrinking, then we look to get out. And those businesses that that we would have owned in the past that are that are more problematic, businesses that just were cheap on a book value basis, but we never really intentionally owned businesses that weren't growing by and large. There's one company I can think of off the top of my head that we owned many years ago. That was a net present value, calculation, because it was a business that was in liquidation. But other than that, we own businesses that are growing. But I think there's more companies that are being disrupted today than any other point in time in history. So we do want to be careful about understanding what the future might bring. And so when we looked at last year, we looked at the cruise industry. We looked at it the year before that, pre-COVID. We don't love the cruise industry, and don't think it offers the growth, rate that we like. We don't think that's very capital intensive and obviously economically sensitive. And so we didn't really, we weren't willing to get engaged in the equities, but the world goes to hell in a handbasket because of the pandemic. And we ended up buying Carnival Cruises and Royal Caribbean, cruises, and we bought the debt of both of those companies, but we bought these senior secured loans where they were offering, low teens rates of returns. And the only decision we had to make in making those senior secured loans for these two companies that had not in their past ever had to offer senior secured loans. There was always unsecured, subordinated debt that they were, offering. Only conclusion we had to come to was that the cruise industry would be in business. Not that Carnival wouldn't be restructured or Royal Caribbean wouldn't be restructured, but that the industry would still exist. And these two companies, whether or not they're restructured, the boats they were using that we had the first liens on were going to be in operation. These were relatively young boats that we had such large discounts to their depreciated values that even if half the fleet went away, we still would have been, had our assets covered. So those are the kinds of things we love. We can get teens rates of returns where it's very, very hard to lose money. Not the highest quality, business in the world, not terrible businesses, but not as good as we would like to, own the equities, of. And so other companies that are in the portfolio that are more traditional value investments, we have a company called First Energy in the portfolio, Ohio-based utility that ran afoul of the of the law and broke the law, and in terms of getting involved in some graft in trying to with the desire that certain bills would get passed in the Ohio Assembly. And that's a business that we bought as a utility. The stock was down by 40%, and we had a pretty clear understanding as to what we felt the downside was, because it's fairly cookbook as you look at when you look at fines that they get paid for these kinds of crimes. And not to say that something couldn't change in the future, but precedent suggested that it was a very attractive risk reward. And so we bought that company, and that was a very good business, which is a business in a state that is still regulatorily friendly, to utilities, and in a business that is going to have an increasing renewable component within it with all utilities. So we like utilities in general, but this allowed us to buy a utility. We own two utilities in the portfolio, First Energy and PCG, a less regulatory friendly state, but better than it was with given some recent changes in the regulatory environment here in California, able to buy these two and own these two companies at deep discounts to the utility index. So, but still growing nonetheless.
Okay, great. Thanks for that. Let's move on to another topic, and the next slide, please. And I'll just preface by saying, so, you sent over a few slides. I saw this slide and I was like, okay, well, this will be used as an example of, the irrational exuberance, greed, euphoria that's taken over the markets. Look at, SPACs are the poster child of just the money grab. The ducks are quacking and Wall Street's going to feed the ducks, and there's a lot of crap there. But then the second slide after this, suggested a different story. So I'll just leave it there and let you share what you'd like to share on SPACs.
Yeah, so the prior slide, was, showed the massive amount of dollars were raised for these blank check companies. Thank you. You've had in the last, 15, 16 months, you've had almost $200 billion raised by companies that were going to then go buy other companies and put leverage on them. So we're talking about, leveraging it and raising more equity capital for well. But so that 200 billion, the hope for that would mean would be something in the order of 700 million to 700 billion to $1 billion of purchases of businesses, both public and private, largely in the U.S., some outside the U.S. And now that's like a lot of it's like faith-based investing that these sponsors are going to go and find something for you to do, and they were bidding them up at a point in time back in February. And you mentioned one of your other managers, that own these, and they were very, nimble in selling at a very good point in time, because when they're selling in February, the average premium was north of 20%, 25% for the trust value, the net asset value. So the unique thing about these special purpose acquisition vehicles is that you raise the money and you don't have to actually buy the company that they put in front of you. You can go and give them the money back, and you can ask for your money back and say, look, I don't like this deal, so give me my dollar, give me my $10. So if you go to the next page, next slide, and you can see the discount where it gapped open to 25% in the first part of the year is now hardly at a premium at all. It's just a couple percent. So what we have been doing is been buying a basket of SPACs and buying them all at or below their trust value. So if our cash is earning us nothing, giving us zero, more or less zero rate of return today, if we can go get even a 1% rate of return across this, over the next year or so, while these are the finite life, these SPACs around 2 years from original issue on average. And if we can go and buy these SPACs at a discount and get this free option that these sponsors are good, and they actually buy something that's attractive, if they buy something that's really good, one can see these SPACs trade up dramatically. So we have a basket of them where if we end up with, it's still not a full position, we're continuing to buy a host of these today. But if you end up with half of your, just keep the math simple, half your portfolio trading up at to a 10% premium, then we're going to get a 5% return on this, and that over the next year or so. On the other hand, we may not get that bump at all. Maybe we get it says 0%. Then we're just not going to lose money. So if you can set something up where you're not going to, where it's hard to lose, and you have the chance of making something, then you may as well do it. And that's what we're doing across that portfolio. It's not, given how many we own, it's not going to be a huge rate of return. But I look at it, with the upside optionality, it's something that's better than a sharp poke. It's better than cash, and I would argue it's better than the high yield market today.
Okay, let's move on and cover some other points. Thanks on that. Next slide segues into other areas of investment opportunity, and this is certainly a more meaningful one than the SPAC position might be. And this is getting into your exposure and the evolution over time into a more global opportunity set and investment opportunities that you've taken advantage of, the team has. It's numbers on this chart currently in our sleeve of the Alternative Strategies Fund, 40% in companies domiciled outside of the US. Most of them are global, but that's up from about 20%, 4 years ago. So just briefly, what's driven the geographical shift, and then maybe we can hit one or two, interesting names, or maybe just one for the interest of time.
I think that the geographic shift has been driven by lower valuations outside the United States. So again, going back to this earlier statement of mine, own a better quality business at a better price, there's more of those showing up outside the US. And again, you made the point that they might be domiciled outside the US, but they're global businesses. So to touch on one, this is a company that we talked about yesterday as one you might want to, touch on during the call. It's a larger position in the fund, Lafarge Holcim. Lafarge is a cement company. So it's not that go-go growth company. It's a GDP plus, kind of grower, that exists around the world. So although it's based in Europe, they only have 30% or so of their sales coming from Europe, and 25% or so coming from North America, and 20% or so coming from LATAM. And then you've got, emerging markets in Middle East and Africa, providing the balance. So here you have this global business that's got a good management team, better management team that's had historically, generates a tremendous amount of free cash flow, that's been being reinvested wisely, we believe. We think there's more opportunities, in the future in front of this company, because I think you're still at a place where construction has slowed down around the globe. They've got some parts of the world that have been worse, like the Middle East and, in North Africa. And so we think this company will be a beneficiary of, the improving economy. It's not demandingly priced. It gives you a 3.5% dividend yield. I mean, so even though our stock is up, I don't know, 40-ish%, from purchase, maybe a little bit more, it's something that we still find relatively attractive. But again, it's something that it doesn't have the sex appeal that a internet stock has.
Yeah.
And we're okay with that.
And do you apply in the valuation? Well, there, just quickly, on a company like that, a materials P plus grower, I guess I'm getting at the discount rate, the cost of capital, or how you clearly you value that differently than you would at Google with a higher growth rate.
Well, yeah, to keep it simplistic and just look at PE. I mean, the PE for a business like this should be lower than a Google. The company will not grow at the same rate as Google for the next 10 years.
Okay, thanks for
If
keeping it.
If I had to pick one company that would own over the other and just have to be, go to sleep for 10 years, it would be Google over Lafarge.
Yeah.
But that doesn't mean that for the thoughtful investor owning a business like this, that's undemandingly priced with a 10%, free cash yield is with upside opportunity. I mean, we should be buying businesses like that.
Yeah.
It's a portfolio decision. We don't know, as you look across our portfolio, which one company is going to be the best performer, nor do we know which one's going to be the worst performer, for that matter. But, we try and be thoughtful, as we look across these, across the portfolio and own a basket of different businesses and different industries and different regions, as well as owning certain different other asset classes to try and create a portfolio that is robust to multiple outcomes.
Yeah. So before we move on, well, it's related to this topic, but a question came in since we mentioned Google, and it's getting back to, disruptive businesses, the FANGs, their dominance, within the S&P 500, the concentration of the top 5, top 10 of, more than a quarter of the index, and how they've driven, the total return for the market. The question is, have you war gamed scenarios where the FANGs get disrupted? Can you imagine scenarios where the concentration of the top 5 or 10 goes down in the future? I mean, because if you look at history, let me just follow up. You've said that we didn't have companies like Amazon and Google and Facebook 20 years ago, but Exxon, AT&T, Intel, Microsoft, like every 10 years, there's the top 10, right? And Buffett showed this in his, just as the annual, like the top 10 have changed every decade, except for Microsoft for the past couple. So how do you think about the potential for these amazing businesses to be competed away by the ingenuity of entrepreneurship and innovation and regulations and antitrust laws?
Well, that was that. You actually answered part of the question with that last statement. Is the disruption? I don't know the questioner. As he's asking the question, I'm presuming means through other corporates, but it can come through government, right? That disruption. Yeah. So we're very mindful that the world can change, and it's our job to constantly underwrite and re-underwrite, and then re-underwrite again, and always have in mind these key performance indicators as to what are the drivers of these businesses. So we look at these companies, and they're disrupting each other, because at first you had Google collecting the ad money, then Facebook started collecting the digital ad money, and now Amazon's in there collecting the digital ad money.
Yeah.
Okay. So I think that I don't think that I think it's a fair question, and it's one that we have to constantly monitor. These businesses, no business is forever, as the questioner, I'm sure, surely realizes, and as you realize as well, and made the point. So yeah, so the question though also is how might, they go to how might that happen? Regulatorily is one, and look, these are advertising companies, and trying to figure if there's a better mousetrap that gets built, then advertisers are going to go and find it. One of the things it's just not happening anytime soon. One of the things that's happened with COVID is that traditional advertising, COVID's created a lot of changes, and it pulled them forward. It's pulled them forward in the form of advertising, and where people are in their cars less, so billboards aren't as important, and people aren't listening to the radio as much, and then the streaming has pushed people to streaming, and the streaming is mostly ad free if you're paying a monthly subscription. So the advertiser's got to find a way to get to the customers, and this has really pulled advertising into the digital realm, and it was already going there. It's just accelerated, and Google and Facebook, first quarter numbers blew everybody away. They were far better than the consensus, and the consensus was much better than last year's. So right now the trend is their friend, and that's continue to be the case until it's not. But we don't want to put our heads in the sand and say it's this way forever. Sure. I'm looking at the questions, and somebody's asking me to show my socks.
Oh, I didn't know you could see those. What's the reference
point on that?
I think it's probably someone who attended one of our face-to-face conferences when we would sit up on the stage with our legs crossed, and you had some striped socks one time. So there you go. He's going to do it. All right. I was going to save that for the end. I like the shoes too. Just for the record, the dare was for me to ask that, and I was ready to take it on. You know me. I'm not going to back away from that. Thank you, Steve. Well, that. I was going to say that wraps it up, but no, we've got a few more minutes. Let's move on to fixed income, from stocks to fixed income. And speaking of stocks, it's another Warren Buffett quote, right? People like buying their socks on sale, but they don't want to buy their stocks on sale. So you can sound profound with your friends by saying that. People hate when prices go down in the stock market, and they not contrarian value investors, of course. But okay, so nice socks was the comment back. Let's talk about fixed income, and slim pickings comes to mind, and that was a phrase I think from your old colleague, not to call him old, but who is still out there, right? Pounding the walls for someone to listen to him, but someday the world will come around, I suppose. Putting that aside, what's the fixed income opportunity set? How bad is it right now?
I mean, I think that it's terrific if you have the opportunity. So if you like low yields for highly leveraged companies that have some of the weakest covenants you've ever seen. Other than that, it's great.
Yeah.
I mean, no, in all seriousness, I mean, you got the high yield market, trades at a give or take, I don't know the exact number, around 4% yield. That's a gross yield, because that doesn't take into account, some level of defaults. So when you kind of work through the, some level of defaults, you're someplace in the low single digits, and that's horribly uninteresting. So that explains why our high yield book is as small as it is. And we started boning up and really trying to put capital to work a year ago, and the opportunity set really existed for maybe 7 trading days, or less. So, and because what you have to do when you re-underwrite all these companies, or underwrite all these companies and re-underwrite in many cases, is you have to be very sensitive to covenants. There's a lot of quote, call it lender on lender violence. People in different parts of the capital structure trying to, they're fighting each other. And then you've got these poor covenants that gives the borrower more rights than they've ever had in the past. So you end up with different assets being, taken from you because they can. It can be the internet, operation for, a moribund retailer. It can be the online gaming, operation for, a casino, company. So there's a lot of this has been happening. So when you buy these assets, it's hard to know what you're getting. what you would get ultimately rather in a restructuring. And so one of the things I think is particularly interesting today, and it's something we can do some of, and we've done some of, is private credit. I think private credit gives you a path to solving for two of the issues. One, better covenants. Two, higher yield. And so if you can get a higher yield, in the low teens, and you can do it with better covenants and you got the really good asset coverage, that's there, then you should do that. So we've been doing a little bit of that in the portfolio, and there's been some names that have flowed through there. We're kind of in this, in between place of trying to, we've turned down a lot more recently, but as an example, and it's been going down, it's not a big part of the portfolio anymore. We own we have a loan to a company called BJ Services. It's, BJ's is the oil service company that was an LBO. And, this business has not been, look, it's been impacted by, COVID. Oil prices, dropped through the floor. People stopped drilling, and for shale, and their business went, they didn't make their numbers, to say the least. But when you own an asset, when you make a loan and you're collateralized by hard assets, we have, this is an asset-based loan, that we're in the process, of liquidating these assets, and we're going to come out, whole, in this, and we're going to have a return that in a bankrupt company that's going to generate us someplace in, I guess, in the low teens. And so we've been doing this for the last 10 years, and we've put, across our portfolio, portfolios that our team manages, over 800 million to work in private credit, and we've generated a yield over 14%. And we've had only one loss along the way, and that was one of our smallest loans, and that was on the books, and we only lost, I think, 8%. So this is something that we'd like to do more of, and we're just very selective. And let's be clear, we're not private credit managers. It is just an asset class that we have exposure to, and we're looking for places where we can participate.
Yeah, and I guess just to piggyback quickly on that, I mean, that is to highlight one of the advantages we believe our fund and the strategy you run for our fund offers, is that providing that additional flexibility on wider bands, unconstrained to an extent, and private credit and private investment opportunities, again, will never be a huge chunk, but just to let listeners know, in the we've talked about in the 10 to 15% kind of maximum range for your sleeve, we're very comfortable with you as one of 5 sub-advisors. You're pretty far from that here, but there's room if the opportunities are there to really meaningfully.
And we hope to be able to take advantage of that.
Yeah. Okay, I have one last question, just kind of big picture wrap up, and it's been a crazy year. I hope everyone on the call is personal health wise and family and friends. I mean, that goes without saying. So we'll focus on the investment markets and that realm here where we have the expertise. But just curious of any particular surprises over the past year, and or any lessons, kind of permanent lessons learned that you're implementing in your investment approach based on what you've learned and seen in this past 12, 13 months.
I think we always look for analogs. And I don't think that the lessons learned were more affirmations of lessons that we've studied and understood to be true. And it just gave us more conviction in what we've already believed. And that patience as an investor is incredibly important, waiting for the right opportunity. And if you own a good asset, that value of that asset is appreciated, would then be appreciating over time. And just because it's marked to market stupidly for a short period of time doesn't mean it remains there. I mean, AIG is a good example of that in our portfolio. I don't want to call it a great asset, but it's a good asset that had a book value at the beginning of 2020 in the mid 50s, and the stock ended up trading down this intraday in this under $17 a share. It didn't make any sense at all to us, and it's something that we ended up we had a good sized position in it, and we let it increase in the portfolio, and now the stock's back up to almost 49, and that's a pretty good proxy for being patient, and patience is always been something we've stood by. It's something we talk about in over the years, but it's nice to be able to see that put into practice. And the world, this pandemic's been horrible. It's been challenging to all of us in many different ways. Potentially our businesses, potentially our family and friends, etc. Hits us professionally and personally. And it kind of forces you to face this your mortality, and that can wreak havoc with your thinking. But if you just look back to 1918, 1920, look at the Spanish flu, and that influenza epidemic you had at the time, when 100 million people died globally, and you had less technology, in science at your beck and call to get under control. We survived that and moved on into the Roaring 20s. And so I think that the more the world changes, the more it stays the same. You have to always anchor yourself to find that place where this is not so different. I remember talking to Lippman Gregory back in 2000, in 2001, and talking about the Twin Towers, and what was happening, what happened to the economy as a result. And I remember making the point then, it's like, look at Israel with enemies on at most of its borders, and whose economies continue to grow faster than the US's throughout the 1990s. People will adapt. We will be fine in the end. Now, your portfolio may have a mark to market, but as long as you have the staying power, as long as you're not trying to buy something for to make money the next year or two, then you should be fine if you have that longer term time frame. Go back and look at the 1930s. You go through the Depression. You lost money in stocks, on a nominal basis, but on a real basis, because of the deflation that existed in the period, the world deflated at a rate faster than stocks went down over the 10 years. So you actually made real dollars. You increased your purchasing power in your portfolio in the 1930s by owning stocks all the way through. And so we're always looking for those analogs. So there's not any great new lessons learned, but there were wonderful affirmations. But it's also, when you talk about lessons learned, it's all evolutionary. The businesses that were great yesterday won't be great necessarily tomorrow, which speaks back to that question of things getting disrupted. So I'm sitting here in my office building. There's not a lot of people here, and we're still only allowed in LA County 25% of capacity, and we're not even close to that in our offices. And we have people in our firm. We've learned to operate very well remotely. Thankfully, we have a wonderful IT department. But we have two analysts moving to Texas. We've got one person business development went to, and client services. We have three people in that department who've moved to Boulder, Colorado, Las Vegas, Nevada. One's moving to Santa Barbara, another one's has already moved to Chicago. And we had hired somebody along the way to help us who's in Kansas City. We have a new compliance person from New York. So I don't need this space. What does that mean to the landlord? Will there be somebody else to come in and take our space when our lease is up? Who's going to absorb this space? As people are more comfortable with the work from home scenario. What does that mean? So these are the questions we're always grappling with, trying to understand how the world continues to evolve.
Excellent. Well, we're a little past the hour. I think this was a great conversation. I benefited from it. I hope our listeners enjoyed it. And if nothing else, I hope someone captured that screenshot of when you were lifting your foot up with the red and white socks.
They're pink. They're pink. My
daughter
bought them for me for Father's Day last year.
Oh, very sweet. So once again, Steven Romick, thank you for playing. Appreciate your time. It's we're as always. We keep our eye on you, so I don't want to. Just as you got to keep evaluating the companies you own, I don't want to express undying gratitude. But I was going to say we appreciate the partnership. We benefited from long-term investment with you and your team. We try to keep you honest in our questions and due diligence, but again, we appreciate the work that you do, and ultimately for our clients and shareholders in common. So I'll pass it back to Mike and thank everyone for being on the call.
Thank you, guys.
Yes, ditto. Thanks, guys. Appreciate the conversation, the presentation. All of everyone who joined us today, thanks a lot for spending the time. We really appreciate it. If you have any questions about the fund or any interest, by all means, please reach out to us. Otherwise, thanks. And until next time, we hope you can join us for the next webinar. Take care.